Okay, so I think we can start now. Good morning. Good morning, everyone. Thanks for being here. And I just want to check. Just want to check if everything is fine here. Very good. So good morning, and thank you for joining. I'm Giuseppe Basile. I'm also known as the Fips Talker. That's a little bit of maybe aggressive name, isn't it? But we are all in a competitive business, and this may well be appropriate. So very good. So let's get it started then. Thank you for tuning in, and thanks for ForexStreet.com for giving me the opportunity to present this webinar. And I want to try to make, as usual, this webinar relevant to you. And today I'm going to share a few concepts around some of the most interesting and dearest pieces of research that I've produced in the last few years. So I hope this is interesting, and to make this webinar relevant to you, what I'm going to do is I'm trying to keep it as much as interactive as possible. And what I'll do, I'll try to give a lot of space to the Q&A. So I'll introduce also some concepts in the areas of market structure and microstructure. So I hope this you will find this interesting, and I'll also try to show how normally, we all think about the market, and I hope this will be relevant to your trading, and I want to try to answer your questions as well. So, good morning, everybody. Thanks a lot for joining in. So the what I would like to do, I would like to give you a fresh perspective on the markets, and how I go to think about them, and also what has been my path of development, if we will have enough time, because we have one hour and a half. I'll explain you a little bit how this is going to work. The only thing I ask you is to keep an open mind, and to be very honest with you, after reading and studying hundreds of books, I've tried almost everything that is out there. And I've discarded a lot of the things that are under the sun, and the majority of the concepts proposed in traditional approaches. So I ask you to have that same approach, and bear with me, and keep your mind open, and listen to what I have to say. And then check it and double check it. One more thing, for those who know or follow me, I have a very practical approach with no string attached. To be of interest to me, a trading method has to be grounded in the way the market works. So, a method has to provide an entry, a stop, risk-free trade, profit levels. And if the method then builds in also a way to identify levels that give us information on price discovery, or what the price is going to do in the future, that is a good plus, and I'll take it. I'll be very happy to have a method like that. So let me provide you a little bit of idea of how this first part is going to be structured. So we will have 4 sections in this first webinar. The first one is how the market moves, at least how I believe the market moves, and also then in the second section try to break down and show you different dimensions we can use to look at how other people, how in average traders look at the market. And in the second part, we will look at how I model algorithms, particularly a class of algorithms for prevent trading, and also talk about HFT. And this will, I will touch on this also in the first part, and will give us a good opportunity to look at price market structure. So if we will have time, I'll also talk a little bit about psychology, the stage of a traders, and consistency. The second webinar is going to be focusing on a very effective setup from the past, how program trading incorporates market psychology, and I will give you a proof that program trading has incorporated market psychology, and actually it kind of works under the hoods. We don't perceive that, but it's there. It's very powerful, and that's part of my trading edge. So before we continue, get a look at the disclaimer here. Always keep in mind your risk. I use an acronym PPC, protect precious capital, which is the rule number one of the game. So if the money is gone, then the game is over. So I know that speaking to a broker recently, 22% of traders still do not use as stop loss, and they end up getting a margin call. So they end up being wiped out. So be very careful. I'm also very adamant about risk management, and I also had a good experience with money management. In fact, I wrote a research paper in 2010 on the linkages between money management and trading objectives. So we know that there are linkages with the trading results, of course, but there was a new piece of research that links now money management also to the trading objectives and trading goals that we define for ourselves. I'm also a fan of doing things differently. Guys, 95% of traders are not successful in this game. So I don't want myself, I don't want people to become part of statistics. And so what I prompt you is to always ask yourself, how am I doing things differently to be a winner rather than statistics? Because unfortunately, if we don't do things differently, we end up being part of the 95%. So no promise. I hope that is fine. So if you're looking at the recording at the moment, just stop it here and read the recording. So let's dive into it. A little bit of information about myself. I'm a computer science engineer in 1999. Worked for Accenture for a number of years as a consultant, traveling around Europe. I became manager in 2006, and then but my interest in trading started in 2001. And in 2003, I committed to research. I thought that I understood that I had to research the market. And in 2006, I understood that I had to get mentors as well. And I had a number of mentors, Van Tarp, Ivica Juracic, Dear Barton, David Asley, Jody Napoli. In 2009, I stopped. I left my job and started trading full-time for 4 years, and I added 7,000 hours on top of my previous almost 10,000 hours of market exposition. I started Philip Stalker in 2012. I also took a master in finance in 2010 and became a CMT in 2012. And I write and do research for IFTA, the International Federation of Technical Analysts, for which I've published a few research papers. I'm about to launch in July 2014 Philip Stalker Trading, which I'm going to share my trading method and do mentoring and trading signals and part of my research. So that's about me for those who don't know me. So let's start at looking at how I believe the market moves. So I believe the truth about market success is not in the books, as you can understand. And I think we have to bust a myth. Traditional technical analysis will not make you successful. And the reason is that, although the overall market behavior has not changed in the last 210 years, and I suspect will not change in the future, market microstructure has changed, and that means who makes the trades and how the trade is made, and the point is that this microstructure, although it's changed, although there is a lot going on a lot more going on in the markets, high frequency trading, algos. I don't think that the microstructure and price structure is affected above the 1 hour. And technical analysis is just a way to represent historical statistical data on charts, and that is really what is it. If you want to prove, well, it's very easy. 85% of traders are net losers, and 10% devolve their time for free because they barely can pay the cost of trading. So my question has been always, what is the 5% elite doing correctly, and what the majority does not do in the right way. So the next question is, you all know probably very well or have heard about the Mark Douglas trading invention. So what prompted Mark to write the 7 principles and 5 truths of trading? We are too much worried about identifying the next trade, worried about the method, but the real powerful tool, in my opinion, that help us to understand how the market moves are all psychological in nature, like risk acceptance, probabilistic outcomes, fear, greed, and I'm going to show you this. So I already told you before, what I love to do is to define my training method around grounded facts about price behaviors and the way modern markets are. And here, what I want to do, I want to go through a few areas, a few points, and so I think we need to start from the basic again and remove the majority that has been built around price. That's my idea. The market moves in waves, we know that, and those waves compose together in sequences. And trend, we know, are characterized by higher highs and lower lows. I'm not going to spend a lot of time on this. I will give some of these things for granted because I know that a lot of people, just study and read a lot before dealing with the market. So modern markets are participated by algos. I'll give you some details, and up to 80% of volume in certain markets. High frequency trading is there. It's also very powerful, a lot of volume, and it changed market structure, as I'm going to show you. Technical analysis, we all know it's late, and the statistics are not good enough to cope, in my opinion, with the 7 principles and 5 truths of trading. Now, I would say not all of them. So this might be a very bold statement, but let me articulate on that, and I'll show you what I mean. So despite this, I have a very deep and huge respect for people who use pure technical analysis successfully. I believe that their success comes from discipline, psychology, risk management, and money management, rather than the effectiveness of the method. So I'm going to show you some statistics later on that prove this point. So there is one question that remains, right? So if we believe we have a better edge, why we should not take advantage of it? So let's start from trends. I mean, I'm not going to spend a lot of time on it because we all know we're talking about the concepts of trend was initially introduced by Charles, and we know that. And he introduced a concept like trend analysis, rallies, sell-offs, primary, secondary, minor trends. Now, most proponents of the Dow theory says that there is quite a considerable amount of noise in minor trends, and minor trends could be the daily time frame, right? So I believe that there is healthy noise and this is brought about by algorithmic trading, as I'm going to show you. Yes, algorithms are automated trading programs. When I speak about algos, That's what I say. It's not really auto trading. I mean, I'm speaking about institutional algorithms here. I'm not speaking about what me and you can run on our computer. Okay, um, as I was just saying, I mean, this now is very, very important. The new element in the picture now is that the existence of trend has been proven mathematically, and here there is the reference if you're interested. And so, is this going to change our life as a traders? Maybe not, but it's very important that what I want to underline really is you always think about behavior that are grounded in the real market behavior and price behavior when you think about your method. And of course, the trend is your trend. This is until it bends. This is attributed to Ed Seikoda, and there is also the nasty one. The trend is your friend until that nasty bend at the end. So we all know this. So now let me give you well, that shouldn't be like this. That should happen at the end. But what I want to tell you with this slide is that just to show you what are the current markets. So an estimate of 80% of major futures are traded by algos, and this is data from the 2009. So today, this could be up to 90% of volume. In the forex market, which is the market that most interests us, it was 25% of volume in 2006 and estimated 45% in 2010. So after 4 years, again, this number could be higher. Volume, 20% in 2010, and then there is the high frequency trading. Sorry, my apologies if there is this, you cannot read properly, but I'm going to read this for you. So estimate for high frequency trading is between 35% and 75% of the equity volume on the European and American market, which is huge, and I'll show you later on what are the effects of this. So there are some sources here, so you can double check this. And the question that I gave at the very beginning, are we sure that we want to keep using traditional methods if we know that now markets are so different? So that would be my question here. The next is high frequency trading. So high frequency trading, I'm going to do a little digression here on high frequency trading because this gives me the opportunity and you the opportunity to understand a little bit price structure. So what is the structure of price at a more micro level? And this relates directly with high frequency trading, which is a phenomenon that is very important, especially for people who want to trade news. I personally believe that this style of trading news, it's not well. News trading is not for me. I don't believe in it. And so let me give you a definition of high frequency trading. It's a practice that attempts to obtain an advantage. A disadvantage is unfair. And we're speaking about algorithms that are able to exploit a small difference in price between different markets. For example, think about forex, a forex pair and its futures, or a forex pair and options, or a stock and the ETF. Right, the ETF is the basket of stocks. So the price differences are exploited through an ultra-fast execution of trades. And you have to imagine that under the ground between Chicago and New York, there is a tunnel with cables that give high-frequency traders companies an advantage of 30 milliseconds on execution. So that's how how quick and speedy are these algorithms. And they need a computerized technical infrastructure. So me and you, we cannot practice high-frequency trading. When people, they say, do you do high-frequency trading? I mean, if you tell them, well, that's another game. That's another level. I mean, I cannot do that. And high-frequency algorithms, of course, run on dedicated platforms, and they're attached directly to the markets in North America, and in Europe, and everywhere around the world. So now I think it's very interesting to understand a little bit what price structure is. And is everything fine? Hope everything is fine. Can I continue? Give me a yes if I can go on. Okay. Very good. So I hope this is interesting. Give me a yes if you find this interesting. So far, okay, good stuff. So okay, so we can think of market price structure as the way price evolves, and that's very simple. The normal market structure has these characteristics. So a healthy, robust market structure is liquid, which means that there's a large volume of exchanges. There's a deep book, which means that there is rich demand and offer at all price levels, and the spread is small. So the spread may be 1 pip, 2 pips between bid and ask. So when the markets are healthy and robust and normal markets, the liquidity providers are rewarded. And I'm going to explain you who are these liquidity providers, right? So those are people like me and you when we trade on the small time frame. I'm going to show you in detail. And but a more formal definition is that these are the traders on a time frame that take the other side of the trade made in the direction of the prevalent trend on the time frame just higher. And I'm going to show you this in an example. So this is the most important point to understand. If in a market liquidity providers are not rewarded, then the market becomes unstable. And events like the May 2010 flash crash take place. So if you don't know what the flash crash is, just research on Google and read a little bit about it. I was there that day. I was not trading, but it was unbelievable. With the SP 500 losing 9% in a few hours. So give a look at that, and so let me show you an example in the next slide. So what you see on the right side here is a healthy market structure. Now, you know, the style of price structure that I do is based mainly on the work of Joe Di Napoli. I believe Joe is one of the few practitioners who really understood the far-reaching effect of HFT on price. And he really got the picture. And so the black lines that you see in this picture here is let's say the larger time frame, let's say 4 hours. Okay, the blue broken line represents the price action in the time frame just below, and I would say that this is the 15 minutes. Okay, so now let's assume that a trend follower on the 4-hour chart was capable of buying a retracement into and just got into a T1 into A. Let me see if I can annotate without creating any problem. So the larger time frame trader enters here. Now let's assume now that you know, traders on the smaller time frame try to pick a short at A primus here, which is this T2 here. And what happens is that, of course, the timing of these guys is not perfect. And what happens is that you know, they're trying to pick up top. But what happens is that the market continues going higher. So they're showing a loss. These traders are the liquidity provider. Why? Because they allow the trader on the larger time frame, which is this black line here, to keep buying in the direction of the trend while the price moves from A to B. Okay? So these guys are the liquidity providers. Now, what happens if the liquidity providers miss meetings? If they miss the timing here. It happens that the market goes a little bit higher, but then it corrects. And as you can see, if let me clean this. If these guys who bought here do not sell above a primus here, but they wait they can always exit with a gain. So kind of they are rewarded, as I told you before, for providing liquidity to the larger, those who operate in the larger time frame. I hope this is clear. It's a very simple concept indeed. So this is what a healthy market is, a healthy price structure is. Now on the left side, let's look at what happens when high frequency trading is active on the market. So now what happens is that these guys here, they're buying, but what happens is that, look at this, the market does not retrace. And when high frequency trading is in the market, actually that's exactly the effect. So, and as you can see here, there is not really a lot of opportunity for the guys who enter here to exit with a gain. They always exit with a loss. Even if the market, the liquidity provider leave the market because they're losing money. And what happens is that this creates condition for the markets to moving higher without retracement, because now there are no guys who are selling here in high times to the traders on the larger time frame. So this is very important, and high frequency trading acts as a liquidity provider in normal market conditions. But however, when because high frequency trading is not regulated, what happens is that they disappear at the very right moment they need it the most, and defenders of high frequency trading lose his or her partner when he or she loses the job, exactly when the significant other is needed the most. So that's exactly, to make a parallel, that's exactly what happens. So I hope this gives you a little bit of perspective of why you should avoid trading on the smaller time frame and what's the effect of high frequency trading on our markets. Are there any questions on this? Very quickly. Take over trading. Well, there is a chance, and there is a big, there are new trends in trading. I believe there are some elements of trading that until there will be a participant, a portion of human participants, they will still stay in the market. But basically, the algorithms have already taken over the market. So, and the market still respects some rules. And as I'll show you later on, it's still in the second part, especially algorithmic trading somehow incorporate the psychology of trading. So. We have a chance anyway. So that's the answer to your question, madam. And is the 15-minute chart stop hunt 1 minute chart and 1 hour or 4 hour stop hunt 15 minutes? That's correct, exactly. You can see that every time frame has their liquidity provider. The only time frame that does not have liquidity provider is 1 minute of the tick chart, because below that time frame there is nothing. Okay, good stuff. So let's continue. Thanks a lot for your question. I really appreciate it. So let's continue then. So this is an example of an healthy price structure, of course, as you now understand. So do we have to say a lot about this? If you're a fan of technical analysis, I have to disappoint you. I'm very, very sorry to disappoint you. So however you slice and dice it, technical analysis will not make you successful. And that's my opinion, of course. You might be a different opinion. I respect that. I think it's very difficult to be actually now successful with technical analysis. So here is a very, very simple example. This is a stochastic, slow and fast crossover. You can see here that out of 5 signals here, I only have 1 signal, which is okay. And actually, even when I get this signal, that's you get the trade, no signal here, delayed. And look at how program trading on the other side, and this will be more clear later on, provides very good signals here. So If we trade as a function not of price, but as a function of psychology, I can promise you that you can have much better results. So not really a lot to say on technical analysis. Let me see if, no, these are some statistics that I've extracted from a source. This is for stock analysis, and I've been trading the stock analysis for some time. This comes from the Encyclopedia of Chart Patterns by Thomas Bulkowski, and also with estimates from actual trading. So if we look at these figures here, we see that all these beautiful continuation patterns, like bull flag, pennants, ascendant triangle, base, flag, and bear flag, up to 45%, with a target rate that target rate is the percentage of these trades that go to target. That goes from 50% to 90%, which is very, very high. Well, the reality for me is not very different. I did that by trading that. I saw a failure rate of 60%, which is a reliability of 40%, with a target rate only for 25%. So, do I think this statistics apply for everything? Almost, including forex, and that's my opinion. That's my opinion. So, just want to wrap up here the first section and look at what we have observed so far. So we now know the market moving style. We knew that before. We now know that that's formal as well. It's been proven formally. So it's a grounded behavior of price, and that's what I'm always interested in. The presence of algo is massive, up to 80% in some markets. The forex could be 50% or more. There is a huge presence of high frequency trading that makes even riskier trading the small time frame, and we discussed that. We saw how price structure changes in presence of high frequency trading, and the technical analysis is not effective. So price lagging, real trading. Shows that the data that I showed before. So why adopt a 30-40% reliability method when there are out there reliability methods of 70-80% reliability? And I don't want to do any promises here that you're going to get those. But when you switch and start trading a function, not a function of price, but a function of psychology, you'll see that things change. So we completed the first section, so I'm going to move into the second section, which is going to be hopefully interesting as well. I'll answer the question later on, so I'll close the chat. So don't worry, I'm not ignoring you. We will keep your questions for later. I'll answer all the questions, okay? So let's start with the second section, how the average trader, how I believe the average trader looks at the market. I think there are different dimensions we can use to study and reflect on how traders look at the market. And I identified for this webinar these 6 areas. There may be more. The most common misconception about trading. So what people bring into trading that come from their own life, but is not convenient in trading. The major well-known trading concepts, which are actually, these are the dimensions, which are actually published on a incredible number of books. The most common system that leverage some of the trading concepts, important. The bandwagon theory. Now, let me check this. Have you ever heard about the bandwagon theory? Can you give me a yes if you ever heard about the bandwagon or read about the bandwagon theory, please? Okay, so this is going to be a very important and interesting piece of our discussion as well. Probably. And of course, I consider very important the Marx Douglas 7 principles and 5 truths. So what happens if we think opposite of them? And I try to do this exercise as well. And then, of course, considering trading like gambling and knowing the system stuff. So these are the 6 dimensions I'm going to work on in order to show you how I believe the average trade looks at the market. So let's start from the common misconception. So price like a projectile responds to law of physics. Well, price is not a projectile. Differently from a body in motion, price is not moved by the laws of physics, but is moved by the laws of perception. And the reason, and the justification or the proof is fact that price can actually turn on a dime because perception changes in a moment. And the second point is pure technical analysis can forecast price, and it's a good, can provide good strategy. I don't believe that. A forecast only makes sense if it's grounded in proven market behavior. And I think that not all of them, but a lot of concepts in technical analysis are more appealing to our visual and need for symmetry rather than actual market behavior. So price breakout is a good strategy. I think when you trade the breakouts, everything happened already in the market, and you're not able to take low risk trades anymore. Volume confirms trend, yes, maybe in the past. These days, with dark pools and a lot of volumes out of the exchanges, you really want to trust volume? I don't. So I want to apologize if some of these misconceptions or what I believe are misconceptions is something that you might think. It's nothing personal, of course, that's just my opinion. Take it as it is and do your due diligence, check these things. This is what I believe. And I want to be offensive. I don't want to offend anyone, of course. So preview size and lows are significant. Again, I think they're more appeal to our need for visual symmetry and order. I spoke about convergence of multiple levels in my last webinar. I don't believe in that. I also believe that if you consider the convergence of a number of levels that by themselves are low reliable, then the convergence itself is low reliable. So there's no additional meaning or value in convergence, to be honest with you. But look at the literature. The literature is actually, touting conversion, right and left and right. But so the next one is I'll use a mental stop. That's enough. No, that's not. And actually, you have to be very careful there because I also believe that I also told you before 22% of forex traders lose market. If you don't have a stop in place, you have a stop in place, but it's not you who puts the stop in place, it's the broker. And that stop is the volatility stop, which corresponds to you getting a margin call. And I believe there are some people on this call today who who have experienced that before. Ask me why. I'm one of them. Trading price pattern without taking into consideration higher and lower time frames. I see a lot of people trading 2-3 bars candlesticks. What's the meaning of that if we don't know what is happening in the higher time frame? We cannot just frame price based on 2-3 bars. And again, that's my idea. If you're successful with that, good for you. I'm very happy. I'm very happy about you. And trend lines and geometrical price pattern explain price. No, they don't. Triangles basis, they do not. The price does not care about the line that you put on the chart, and you have to You have to realize that. Method is 70%, psychology is 20%, and money manager is 10%. Well, it's not exactly that. Psychology is 70%, and method maybe is 15%, and risk management is 15% as well. And if I only had that secret fantastic indicator, I hope you will lose this mindset as soon as possible. There's no secret indicator. It's all about probability. So in this next slide, I want to give you very quick an idea of what are the type of trading concepts. I have 11 trading concepts here, but go very quickly. The first one is trend following. So that's about, it's one of the few market behaviors that, as I told you before, has been mathematically proven. And the idea here is that you can make money by jumping on a trend after arbitraging. And that's, I believe, it's the most important concept, and the only one, actually the only one I use, and the only one I hope other people will keep using, because it's the safest and it's grounded in market behavior, and it's supported by algorithms as well, which is the biggest power on the market at the moment. Not only, it's also supported by market psychology, as I'm going to show you. So the next one is band trading. What's band trading? Market will only go so far until then they reverse. For example, Alexander Elder speaks about return to value. If you read Alexander the Elder, which is really the market behavior of really returning to the mean, right? So what we want to do then with band trading, we want to buy when the market is oversold and sell when it's overbought. And some examples use the Keltner channels. They use the volatility bands, and I think that those methods do not take into account price traction. The next would be spread trading. So what's spread trading? There are relationships that we can exploit, and the relation could be between a weak stock or a weak pair and a strong pair. A recent example of a couple of years ago would be in the stock market, Facebook versus Google, right? So when Facebook came out, after the IPO, you could actually sell Facebook and buy Google, and that would have been a spread trade. So the idea there is that you manage risk by selling the weakest and buying the strongest, right? Of two markets that actually are two instruments that are correlated very well to an index or to a specific market. Fundamental, I'm not going to spend a lot of time on this. It can be defined different ways, and it's really when you buy something that is undervalued, waiting that the value will get to the price will get to the actual value, will reflect the actual value. The main point here is that how you really define value, and there are different type bottom-up or top-down approach in stock investing, for example. In forex, it's very, very difficult to do that because to understand all the relationships between countries and within a country and what's happening. I mean, really, it's an hard work, and you might like it, but I think price itself gives more detailed information. We have then price action, excuse me, price action and patterns. You have heard about price action, which picked up in the last few years quite a lot. I believe a lot of these patterns come too late. If I trade a pin bar, it's too late. I mean, the opportunity and the low risk trade was at the top of the pin bar, not when I know that it's a pin bar. So typically after the next bar. Another method, other concept is trading. There is an order in the universe. So like trading cycles, trading Elliott waves. I'm not a fan of this. I think that again I'm not able to do this. Arbitrage is something that is going on since the 70s when the computers were invented. and there are relationships that can be exploited to make money. For example, buying a stock and selling the ETF or things like this. And this may be very hard to find, especially in the small time frame, but a lot of people, institutional traders, they make money on it. And those with an asterisk here, I've indicated arbitrage and FFT with an asterisk. Let me see here. Well, yeah, these asterisks here. Actually, those are only available to institutional traders. And of course, you have now algorithms and program trading, which is what I believe and practice. And this is really trying to study how algorithms have effect on price. What are the effects on price of algorithms? And I call this the footprints of algorithms on price. And this is something we can leverage, and that's where I get my trading edge. Next one, high frequency trading. I explained that to you, only available to institutions, so there's not really a lot to add here. So these are some of the systems that might leverage trading concept. I'm not going to go into details in this. You can see pros and cons. These are only some of them. There are as many systems as many people on the earth. So what I want to maybe just stop the video now if you are watching the recording and give a look at that. But the main cons anyway are always lagging. Signal given too late or too early, signals that are too close to profit-taking levels that program trading is looking at, so very risky, and system that only leverage and appeal to our visual symmetry and need for explanation and visual symmetry. So this, excuse me. You will see this very, 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 very often. So I've read before that that actually some of you do not actually know the bandwagon theory. So let me tell you a little bit about it. It's an allegory of market behavior. It's a very important one, I believe. So you have to understand it. You have to know it, in my belief. I think it's worth alone the equivalent of months and if not years of trading and trading exposition. So that's alone. I mean, it's can save you then a lot of money and also mental pain. Yeah, I hoped I knew this when I started. It is not an overstatement that a profound understanding of this message can actually create the condition for put you in the path for true mastery, trading mastery. So. This theory provides an insight into the inner workings of the market and how the traders are manipulating profits. Now, in reality, nobody can manipulate you. It's blatant self-manipulation because only I, as a trader, can I cause my own demise. So, and if there will be time, I will clarify. The psychology that people bring into trading is their psychology of their everyday life, and that does not work. So the responsibility of good trading results, in fact, lacks in our market, in our lack of market-oriented psychology. So I make no assumption, and you should not make no assumption all the time, and consider this bandwagon theory and study it and read it and check whether it makes sense for you. The point here is that it's not that professional traders are smarter individuals. Those who want to make you think that you have to be a yoga master to do trading. I mean, it's I find it very funny actually. I mean, you have to be a very normal person who understands a few things, and off you go. And important sources are important as well as mentoring is important as well. But the professional traders are not smarter individuals. They just know how to deceive the crowd and how the crowd deceives themselves. So they just leverage on widespread weaknesses. So that's the way it works. So it's up to you to decide in which side you want to be, and I hope this bandwagon theory will help you. And this is not mine, of course. I mean, that's something that you can find on Tool and Taxes of the Mastery Day Trader by Velez and Capra, and there is the page there as well. I'm going to go through it very quickly. What I did, I actually illustrated this theory because it's easier to understand. So I'm going to go through it very, very quickly, hopefully, so we can continue. And let me check the time. Let me check the time because this is 1 hour and a half, and I want to leave some time for questions. So I'll be. Do you know what I'll do? I mean, I'm not going to go into details into it. This might be a little bit disappointing for you, but that's not a big deal because I wrote and illustrated the bandwagon theory on an ebook, and it's a free ebook you can download on my website. So let's do like this. So we save some time because I want to look at the sorry, I can see the screen. Is that okay for everybody? I'm going to give you the link. You can go there and download it for free. There's no problem about it. I just want to save some time and spend more time on program trading and actual trading if you don't mind. Is that okay for everybody? Okay, so my apologies for this. I mean, I just, this information is covered elsewhere, so we are not losing anything really. Of course, I mean, having the opportunity to explain this, and maybe, we will check with FX Sheet if I can have another webinar and focus on this and explain you the bandwagon theory. But you can read about it, and you're going to find this very, very interesting. It's going to change the way you look at trading. So at least that's my hope. So good stuff then. So this is on the other side is very important. I want to cover this. This is negating the Mark Douglas 7 principle and five tricks. Now, if you find yourself doing one of these things that are listed here, okay, no, don't panic, okay? But probably there is something that has to be adjusted. And I wouldn't say that you should stop trading, but you should really, consider that there might be some changes to it. So let's look at this negated principle. So I know what is going to happen in the markets. Nice. Some people, they don't even know you stop. So I don't want to sound irrespectful, okay? So I'll use a little bit of irony here. So forgive me if you find yourself doing one of these things, okay? Nathan, yes, that's Trading in the Zone. That's a very good one. That's one of the best books ever written. And without that book, to be honest, my trading wouldn't be the same. So I know what's going to happen in the markets. So if you think you know what's happening in the market, then I think you are due for, and you have to prepare for large lessons in the markets, from the markets, because anything can happen in the markets at any moment. And your trading method has to consider that. The second one would be, in order to make money, I need to be well informed, know what is going to happen next and why. I don't think so. And news are only, in my opinion, in my personal opinion, a delayed explanation of what has already happened. So, moreover, news can bias you and will not help you to focus on the most important thing, which is price. Third point is, I will increase my risk after a streak of losing trades. And this is, a mistake that I remember when I was studying with Van Tarp in 2006, 2007, I used to make a lot. Now, listen to this. This is very important. And I realized this working with Van Tarp. So the point here is that you should never increase the risk after a sequence of streak of losses. And this is very, very important. Now, let's assume that you had 7 losses, okay? And Now, although the probability that to have 8 losses in a series it's small, I didn't understand one important thing. The next trade can still be a loss because the probability of that trade, it's a statistically independent event from all the previous trades. So, and that's something that when I realized, I said, what the heck was I doing? I mean, I was, increasing in risk, not knowing that, the probability of the next trade is the same. So there is a random distribution between win and losses in every trading method, and we have to realize that. The next one is I do not have to consider probabilities if I have a good method. No, even though you have to a good method, which proven with good numbers, then you have to have an indication that it actually works, first of all, but the trading method itself is just an indication that a higher probability of one thing happening over another. So there is nothing magic about having a very good system as well. Now, exact same setups bring the same price behavior and the same trading outcome. So markets are a repetition of past history. That's what technical analysis wants us to believe, with a nice head and shoulder and all the other nice formation. The reality is that this is simply not true, because even if everything looks similar on the surface, including, for example, the same price structure on higher and lower time frames, we never know what is the real perception and state of mind of the participants. So, and it takes only one trader that can hit stop losses watched by institutions and program trading and algorithms, and the market changes totally. So every time in the market is unique. The next one is I trade subjectively and in a discretional fashion. Maybe you're a mental scenario trader, but trading subjectively and in a discretionary fashion is just following half-backed rules, half-backed system. So you're not really trading any system. And this is a mistake they used to do in the past, and I believe and I know that a lot of traders, they do now. Excuse me. So on the other side, you should have your rules written down and be very adamant and disciplined about them. And I'm not just saying that because this is written on books. I'm saying that because if you don't do that, you will not be successful. Full stop. And and that's my opinion as well. I trade, so I do not have to define risk and use stop losses. We already showed this. If you don't do that, someone else will put the stop for you. That's your broker. So I don't think we have a lot to say about this. And so accepting risk is not important that I can trade all the time. No, accepting risk is very, very important, and not doing it is dangerous. Like, for example, not having a stop. When the risk is too high, you should just give the trade up, not trade. So we don't have to trade all the time. I hesitate to act and take traders with my system when I am not convinced. If you have a method and you have a system, you don't have to hesitate. You don't have to reduce your sites. You don't have to. Otherwise, you don't have a system. Otherwise, you're trading discretionary. And I was commending a recent trade from a trader I reviewed, and actually he cut in 1/3 the risk, so the position size on a trade, and made 60% of what he did. 40% of what he did in the last 3 years. So if you are not convinced, you're not trading a system, or you're not following your system. If you hesitate, you're not following the system. So never pay myself and leave the money I make in the account, so I can risk even more at the next trade. Taking regular money out of your account, it's a very good practice, and because the money out of the account is the money out of risk. So this also shows you that you're successful in trading, and shows you that you are actually doing well. So and you should not make your risk a parameter of of how much money you have in the account. Okay, so I don't need to monitor my trading performance or my susceptibility to making mistakes. There's only one way to improve in trading, and that's to monitor your performance and to have a diary and even a psychological diary. So that's the way to go. Consistent trading is pure luck. There are no principles or truths that regulates trading that have to be respected. Thanks God, consistency in trading is not pure luck. Trading is not gambling, and I'll show you as I'm going to show you later on. So the market has principles and truths that, well integrated in your method, will help you to become a consistent trader. So when you want to know how people look at the market, just negate the Douglas principles and truths, and that's also a subtle way of myself to push you to go and look at those. Okay, so do you have any questions on this? I think this is a very important point. So yes, I'm a purely systematic trader, and if you review the videos on my website, you'll see the way I look at the market and create the trading plan model. So next, we are almost there. I want to actually spend, I won't spend a lot of time on system statistics, but you have to know that there are 4 things you have to keep in mind, and these are very important. Excuse me. Reliability, the number of winning trades on the total trades, and you have to have this number in mind all the time. Otherwise, you're not trading a method. I don't know what you're trading otherwise, and you might even derive these numbers after the fact. If you're a mental scenario trader, then you take all your trades, you crunch the number, and you get these numbers. But you have to have these numbers in mind, or have an objective of getting this number. The next is expectancy, which is the dollar gain in average by all your trades for each dollar risked. Next is frequency. What's the number of trading opportunity in every month? For example, for my trading signals, swing trading signals, they go from 10 to 30 signals every month following 12 markets. So this makes a big difference because then you can consider the expectancy multiplied by the frequency, and that gives you, how much you can do in 1 month for $1 risked. And so, and this measure, and so this is give you an idea of how good is your method. So here I have an example, but I'm not going through it. It's a calculation that having this data, you can actually calculate how much you could potentially do every month if you systematically follow all these trades. And as you can see, you can have a system which is low, which has a low limited reliability, wins only for 45% of the time. They can give you a very good return at the end of the month. So this concludes my second section here. So excuse me. I want to spend some time on introducing the way I look at program trading and how program trading actually how we can leverage the effects of algos. So I'm not going to look at these takeaways, but I believe that we understood that now we have to look at what algos are doing. We have to trade retracements because that's a grounded behavior in the market, and we have to do things differently. And now this QA we will do it later on. I want to introduce the third section here, how I model algos and program trading, so I use some Fibonacci numbers. I'm not going to introduce to you Fibonacci numbers. I think that there are some uninvited guests there. The only numbers that make sense are those that are suggested by nature and nature says that one manifestation divided by the previous manifestation or by the following manifestation gives one of these two values here, which are the values that are relevant. Now, do I use these numbers because Fibonacci numbers are cool and it looks like they have a resemblance in nature? No, I use them because they work. And in fact, there is a 50% number here, which is not even a Fibonacci number, but it works because it works, and we keep it. All the other projection and extension, like 100%, 20%, to 61.8%, I personally really don't know what they are. So I don't use them, but that's my opinion. Now, so I drop most of them. I keep 50%, 61.8%, and instead of 127%, which is a square root, I have 123.6%, which I learned from David Asley, and it works very, very well for profit taking. So this is what I use, and now I use them. So 50% is an entry or a start of a support or resistance level area. 61.8% is a stop and an end of support of resistance. 61.8% also gives information about price discovery. And then we have the targets, the first target and the second target. I use this color code, blue for entries, red for stops, and green for targets. Now, the only way we have to beat the market is take profits. So that's why the FIB stands for beat the market. So then how I do leverage the effect of algorithms on price. So now you understand that there is a way we can use the presence of algorithms. And the reason for that is that algorithms are present on all time frames on a certain large volumes market. This includes all the forex, all the major indexes, all the major stocks, so all the major instruments where there's a lot of volume, because without volume, algorithms cannot work. Algorithms need volume. So what is more important is that we can use Fibonacci retracement to frame price dynamics, and that's the new concept to me. We do not just find a level where we have a high probability of risk change. I use this method to frame price, to explain price. So the same consideration are useful to derive a timing technique that I called the Fib stalking technique, and you can go to my website and review the information I have there. So when algorithms participate to a certain level, for instance, the 50% retracement, they will try to bring a price into the first target, which is the minus 23.6%. So we have a first move, A to B here. The market retraces, get into an area which is between 50% and 61.8%, and then it keeps moving higher, and this is the first target here, the minus 23.6%. This is the 23.6% of the move between A and B above B. So that's the way, that's one of the simple way I look at this, and I hope with time this will make more and more sense to you. You should now understand why trading the breakout is very risky, because the first level where program trading is going to take profit is very, very close, and you see that. So this is not a strategy for me. Breakout is not a strategy. Buying low risk price retracements, that's a good strategy. Okay, so there is also a second target, which is minus 61%, and that's the E, point E in this chart here. So notice that all these values are determined. So before someone was asking, Nathan was asking, are you a systematic trader? Yes, and I'll show you this. And I have the benefit and the privilege of being a systematic trader because of the existence of algorithms. Okay, so yeah, I use this technique every day, and you know, it works for me. You can review my videos on the blog, fibstalker.com. So price can also move in different ways. There are 4 different ways price move. So excuse me. when the second target is hit, change it to highs. Oh no, I cannot say this. You can start using highs to highs and trades highs to highs and have a new entry, which is, as you can see, it's higher than the 50% between F and H, and that's interesting because do you remember those Fibonacci levels, the 38.6, the 32, the 23%? Well, some people they try to capture these retracements using those Fibonacci, but the reality is that we have to look at those retracements in a different way because that's the way trading looks at them. And it's not that I'm saying this out of the blue. I've been studying with mentors and people who have been trying this for years, and they came out with they don't have the time to trade, they don't have the time to trade on the smaller time frame, and there's no reason why they should lose opportunity, and there's no reason why I should lose opportunity. So I made some adjustment and changes based on my own research as well. So, but basically the idea here is that the market can change and start moving as in extended way. So, of course, excuse me. Of course, this is not real. This is not just theory. This is real. Sorry. Of course, this is real. Let me show you. Let me show you that this is real. So, I want to start from, let's see. Let's start from the euro dollar, and you might have seen this already. Okay, so this is the weekly time from the euro on the euro dollar here, and when I start looking at this retracement, the first time it was not here, it was way before. When I started looking at this retracement, this is unbelievable. I mean, the market comes to this area and then hits the first target, then the next measured move does the same, and when that and then the second target, the 122 sits, and 6 have a change in trend. So let me continue on this. When I trace by lows to highs here, you can see that 128.78 acted as support 3 times. This is not only this market. You will see this on all markets and on all time frame. A market that I've been trading in the past few weeks and months is the New Zealand dollar versus the US dollar, and same thing here. So let me show you on the daily time frame. On the daily time frame, we had here, just to make an example, we had a measured move here, a traditional measured move with 083.23 acting as an area, flagging an area of resistance. 083.49 was never pitched on the upside, and the market went into the first and second target. And then the next measured move failed. When the next measured move failed, the market changed direction. Okay, and the failure is 081.51 being pitched on the upside. So look at the beauty of this market this way. And these are the levels that I trace, but these are the levels that program trading is looking at. And price found support at this 085.16, and look at where profit taking was taken, 086.98, this level, and this happens over and over again. Now the market continued trading, and same anchor new high, same anchor new high after the target was hit, and again. Market found support in this area. 61% was never pitched. And when the market again is taking profit, it's taking profit at the same level. So again, these patterns work again and again. This is first retracement targeting the first and second target, and went even below the second target. You want to see this on the weekly? Same story on the weekly, and. I've been, on my website, I've been giving reviews of these markets, and I gave the 081.15 level with a stop below 080.13, and look at where the market retraces. Next trace, where the market retraces and continues higher, now you know the story. So why this level work? They work because there is program trading, which is actually pushing and moving the market. So if you want to get more information about the way I look at the market, I publish a free newsletter every week, and also publish very often. So, excuse me. So I would like to give some space for questions now. Should have done that before, but unfortunately, there was a lot of content to cover. So go ahead. I'm very happy to answer any question you might have, and I probably will be stopped at some point by Arinda. So let's go. I mean, if you have any questions, please let me help us. So Nathan, are FIBs just another form of TA? In a way, there are, but TA, lots of TA. So there are two parts of TA. One part is working on functions that are derived by price, and you usually have those indicators represented outside the price chart. Okay, and of course, Fibonacci is not one of those classes. The second class is that part of TA which deals directly with price. So trend lines, formations, price formations, and excuse me. Yes, the Fibonacci retracements are you can be seen as part of technical analysis. The point is, they model real psychology, aggregated psychology traders group behavior. They don't just appeal the visual. I never use them for confluence or in convergence, for example. I use them to show where there can be participation by programs on price. So yes, formally you can consider that as part of technical analysis, but the 50%, for example, it's involved also in the trade that I'm going to comment about in the second part of the webinar. And actually, I hope you all will be there. The point is, it's not because 50% it's a Fibonacci number. It's not even a Fibonacci number, because it works. So formally, yes. But Fibonacci, as I use them, they model program trading. I hope this answers the question. Please define opportunity in terms of PIP. Aravinda, that's exactly the point. I never define opportunity in terms of PIP, because you have to define opportunity in terms of what the market is giving you at that moment, because your 50 pips or 40 pips of stop or levels might not be relevant in all the market conditions. Okay, so for example, when I trace this from highs to lows, my entry is at 083.21 and my stop is at 083.47. That's at 26 pips. For that specific trade, that's 26 pips, and that has to correspond to my 1% of risk or 0.5% of risk. Okay. Now, if I'm on a larger time frame and I'm looking at this trade here, can you see here that the amount of risk is wider? And of course it is, because we're considering the market on a different time frame and at different conditions. So I never reason in terms of absolute number of pips, okay? But you will always be able to define the number of pips of your risk because of the way we model program trading. I hope that answers your question. Nathan, they do appear in nature, apparently. They do. But again, I mean, remember one of my principles, I only want to define a trading method that is grounded on actual market and price behavior. I mean, to be honest with you, I don't care if it's 50% or 61.8%. Does it work? Does program trading respect those levels? And when program trading does not respect that level, does it give me an additional information? That's what I want to know. Okay. So Bharat, does FIB work on gold instrument? Some people say gold is too volatile for FIBs. Well, gold happens to be one of the markets I follow. So does it work on it? Well, you tell me. I'm going to show this to you if it works on it. Okay, this is a daily time frame, okay? And I don't use these levels. This is just to showcase to other people. So, excuse me. So this is the last March to June here. Let's see if it works. Well, you tell me if it works, right? I mean, there was a front run here, but look at where market went and where the market is going. If you review my market review in the newsletter, you'll see that when this happened, I called, okay, if the market retraces, it's going to retrace at least into 1285. Now, as you can see, it's going above the level. So the level being pierced is going to mean that the sequence of measure move lower has finished. And the next level I'm going to watch for, and program trading is watching for, is this one. So let me give you another perspective, longer time frame. When we trace from lows in 2002 to highs in 2011 here, look at where we had a reaction. We had a reaction right at that 1231 for 2 times. And if you think that this is not common, look at the euro dollar weekly. Same thing. The all-time lows in 2000s, highs in 2008. Where the market reacted twice? Here. So at this level. So at this level important? Do they work on gold? Yes. They work also on all the high volume markets. Any other questions? No problem, Barrett. So I don't know if there are other questions. We can. Thank you, Joe. I hope you are going to follow the second part of the webinar. That's going to be very interesting. I'm going to introduce a trade from the past, and I'm going to give some jaw-dropping long-term charts and show you show you how program trading has incorporated market psychology. I'm very happy. I mean, got to know lots of concepts. My name is Giuseppe. It's written like this. But I'm known as the flip stalker. So, oh, I think I did not. Yeah, this is my name, and this is my blog, and you can download a lot of useful information from my blog. I have my research. I have my ebook, Key Concept of to Correct the Trading Behavior. Don't lose that. Just go to the website and download it, and let me know what you think about it. Okay, I think we have to wrap it up. Thanks a lot for your for being here. I'll see you in the second part, and the next webinar is going to be in 30 minutes, and it's titled "How Secretive Program Trading Incorporates Market Psychology." So I hope to see you there. Go ahead, subscribe. I mean, it's even if you subscribe only for 1 month, just $20. I think besides my presentation, there is a lot of good material there. I do it for free, so but I think that you can find a lot of information there. Thanks a lot, and I'll see you later then. Bye-bye now.